Hi, I'm Nathan Buckhoff with Oxford Partners. I'm here with Matt Rogers today to give a little bit more insight onto the industrial market, maybe touch on a couple of financial and lending details. In general, just a broad overview over the last quarter for the industrial market. Our rents have continued to go up by about 1.5%. Vacancy rates gone up a little bit at 7.8%. A lot of that is with these bigger box tilt wall distribution facilities that need 100, 200,000 square feet of space to lease out and are looking for that. So they realistically vacancy rates for anything that's not that probably more around 3 to 4%. Got a couple of points that we want to go through with Matt today. How you doing, Matt?
Doing well. Yeah, I'm looking forward to it. Yeah, we've been talking. I get lots of questions in our position around financing, lots of prospects wanting to buy and obviously curious about what they need to do kind of step by step to get started and then what the process looks like. And obviously, there's lots of concerns. You see a lot of stuff in the news around financing challenges in office buildings, specifically having some trouble with their debt and they're concerned. So the first thing they want to do is ask us about that. So I think it's a great topic and hopefully it'll be useful to those out there listening.
Yeah, yeah. So I guess on that topic, so what have you seen shifts or different trends and lender attitudes towards industrial assets over the last year?
In some ways, yes. I think whenever the interest rate first spiked, as you can imagine, obviously there was some hesitancy. But I think at the end of the day, business owners really get to a place where they just need to have their own facility. So that initial kind of hesitation around the interest rate spike kind of went away and it got back more to supply and demand. People wanted to own their building, so it was what it was. They'd make the numbers work, try to get a little bit more creative of what they can, looking at different avenues of financing, whatever could make the most sense to keep the monthly overhead down as much as possible. Historically, a lot of business owners that are buying property for themselves get lumped into conventional or SBA lending. It's always been the story there. A lot of times we'll encourage people to at least explore SBA. Those loans are going to be a little bit more heavy on the front end, just kind of good government backed loan. They have some more upfront cost to them, but ultimately the benefit being is a lot of them you can get, or you used to be able to get 10% down, which saves a lot of cash capital for the business for buying raw material, keeping the cash flow going. So that's huge for them. Conventional is typically more 20% down and has a little bit more freedoms than the SBA, but a lot of time that extra 10% is huge for companies. And I think the big shift that maybe has been noticeable is that even though industrial real estate is still the Marvel child for most asset classes in real estate and even for banks, there's definitely been a shift for banks in owner occupied versus investment. A lot of the bigger banks have really started to stay more away from the investment stuff, or if they go that route, the interest rates look a bit different, a bit higher. They're perceived as more risky, I think, from their end. So a lot of time, the owner occupied stuff is where you'll see the better deals from the bank side, just because that's what they want to focus on. Now, there's lots of local, smaller lenders, local that'll be more than happy to take that on. But just from the bigger bank perspective, that's what I've seen here over the last year or two.
Yeah, that makes me even going back to SBA, 10% down it is always going to be a positive or something that makes SBA really attractive. And there's also a ton of SBA preferred lenders that'll not just look at your cash flow, but that will look at your experience and forecast. And you get 20, 25-year fixed rate with no reporting, which is
Absolutely. And I think just for those that might listen in that are curious about things they can do to get started, I think the biggest thing is start interviewing banks, or a lot of businesses obviously do their business banking through somebody. Get in touch with them, start getting over whatever additional financials, but then also go and shop it. And there's lots of banks out there. Some are going to have more interest in deals than others. And ultimately, end of the day, you want to get the best rate you can, the best package for what you're doing you can. And they're gonna request a lot of info, and it takes some time to get those initial approvals. So go ahead and get that process started, just so if you find a property, you're ready to go. A lot of times the good properties that are priced appropriately don't last long. So if you're not ready to rock and roll and you have to have a longer feasibility and closing period, a lot of times you get shuffled to the back of the line when you're in comparison or competitive negotiations against other groups that are ready to pay cash or can do quick closes. So having all those ducks in a row at the beginning is really helpful. And it really just starts with getting in contact with the bank and starting to deliver the financial information that they're going to need to get the ball rolling. The other thing you're seeing, obviously, is appraisals and environmentals are always part of the equation. I have seen an uptick, frankly, in environmental companies pushing to phase twos. I don't know if that's stricter regulation from the banks, just being a little bit more cautionary, trying to cover their bases or not. But I do know that from the finance side, they have gotten tighter on assessing deals, and it's factored out more actually, into lease deal. I know we're going to get to this, so I don't want to jump the ball, but it is something that I've seen quite a bit more. Getting approvals from landlords has become a bigger issue. And I think a part of it really is that they have these bank loans on the back end that they underwrite a lease rate in, and they have to go get approvals to be able to go anywhere near that or below that. And there's just more scrutiny. I still think there's a lot of debt problems on the office side. So those same big lenders have industrial loans too. I just think they're scrutinizing the deals a bit harder, trying to be a bit more conscious of what they're doing. And I just think it slows down the process for us, which is frustrating. And I get it to some extent, but trying to work through the process when you're on deadlines and lease expirations coming, it can be a frustrating topic whenever they're dragging their feet and having to get those extra approvals. And I don't necessarily think it's just on the landlord desk that are caught.
So in regards to, how banks are being proactive when it comes to creative problem solving or creative deal structuring, do you have any experience or insight when it comes to that?
Yeah, a little outside our world a little bit, just because a lot of times it has to do with their finances and what's going in on the back end in the bank's honest interest in the deal. But some things I've seen are adjusting the years on the loan that can help manipulate the monthly payments. Obviously, percentage down, that kind of thing. Historically, a lot of groups wanted to get the locked in rate, especially when interest rates were lower. You wanted to lock in that fixed rate as long as possible, because then when it becomes variable, it adjusts and typically goes up. But now I do think it's a little different. I think a lot more groups are open to that variable rate open on the front end because interest rates are sliding up, sliding down. So there's that possibility that you could end up going back in and swapping it and doing other things to get a better rate later on, which wasn't the case even 5, 6 years ago. So I do think there is some creative things you can do. Again, back to why you shop different bank, different loan packages, those types of things to try to find what works best for you. I think that's real important.
Okay. And while buyers are shopping these different banks, like, what should they be doing to make their deal more attractive to the lender? Or what advice would you give to borrowers looking to finance an industrial property today?
It's tough because everybody's a little different on their comfort level revealing financials. I understand that's your baby and it's important that you keep everything close to the vest, but the more you can open up and be trusting of those bank partners they're not going to be sharing your info. They're not going to go to the IRS. It's nothing like that. But the more you can open up and show them, the more comfortable with the deal they can get, the more open they're going to be to being flexible on those terms. At the end of the day, it's a risk scenario. So if you have the cash available, can put more down, that interest rate's obviously going to come down. You get a lot more leverage on what that deal looks like if you're removing some of the risk for the bank. It's deal by deal as with anything, but I do think that the more open you can be with the bank and the more revealing of information, the better off you'll be. But I do realize that some people do play that closer to the vest. That's going to be more of a personal thing and how open they are to being with the bank.
Yeah. When I think about being open with the banks, the more information that you can give them, the more that they can help you out. I mean, even if your financial situation isn't all shining rainbows, if you talk with the banks, you give them everything that they're asking for. You're as open and honest and transparent as you can be with them. You're going to set yourself up for the best probability of success. And then the banks aren't doing any guesswork when it comes to, oh, do they have this? What's this look like? If you're just open, honest, transparent.
Yeah. As it's any extra question marks they have, they just increase the interest rate.
Yep.
I think frankly, the more risk that they're going to take, the more you're going to pay for the money. So
Oh, absolutely.
from a banking world, the banks that are really out hunting for deals do like to hear the story of the company. They like to know longevity in business. They like to know what their client base looks like, what they're really doing. And they can get more creative with the solution if they like the use or they like the group, they like the history, they like the growth. And lots of companies are comfortable telling their story and they're proud of it. The banks that are good are going to want to know some of that because it can help build the picture, build the package. So when they go sell it to their underwriting department, they can paint a bigger picture, which also.
Yeah. Do you find that's more the case with a small to medium sized bank or lender versus a big box institutional like a Chase Bank or Bank of America? Or have you seen that kind of on both sides of that coin?
I would say that it's both sides to some extent. I'll tell you the bigger banks are gonna be more they have their square peg. It is what it is, but they do have good people at those banks that are in there trying to get to know people, build the picture, and learn. So I wouldn't completely rule them out because I do know good people at some of the bigger institutions that do still wanna get the beer and go and sell it and are very helpful. But yeah, the local banks, regional banks are gonna be a bit more open to creative, opportunities, which is why a lot of time you see some of the smaller local developers working through those regional banks because they're willing to be more open, take on a little bit risk, be partners in the deal. So yes, I would say those banks typically are better for creativity and things like that, but I wouldn't rule out the bigger banks because there are good people there that are going to be able to get to know them and paint the picture and do all those good things.
Yeah, yeah, that makes sense. In my mind, at the end of the day, the banks want you to succeed, so they have a long-term relationship with the business. That way, you use them just more and more. I feel like if you're open with your story, your background, the direction that you're heading, where you see the business going, that can give it a lot of credibility, and it can help foster that relationship with you and the lender. I mean, the lender want, in an ideal world, the lender wants to be your go-to guy for the foreseeable future.
Absolutely.
Are there any submarkets or asset types that are gaining traction with lenders or sorry, excuse me, rephrase that. Are there any submarkets or asset types that are gaining traction with different tenants and investors? I've seen a lot of actually just saw an article the other day about the small bay flex type spaces. One grade level door, maybe 1,200 to 2,000 square feet, specifically talking about the investing side of things, just because they're almost always leased. I don't see very often where they have vacancies, or if they do have vacancy, it's gone in the matter of 1, 2 months.
Yeah, I think I'll go back to the leverage and the risk comparison I was making earlier. For a bank, something that's leased with good quality tenants that has a good yield, is always still gonna be somewhat attractive to a bank. They're not gonna be happy lending on something that's vacant and bigger. But if you're staying in the wheelhouse of what the market is deals are happening at, I think there's a way to solve that solution. But yeah, small bay stuff is getting a lot of traction right now. The third party logistics world and last mile stuff, that's all doing pretty well. Some of the big bulk stuff, like typically those are done in joint ventures, things like that, versus all the way through institutional lending. I think that varies project to project, but I think smaller stuff, like as I said earlier, user buildings where the companies are moving in to be operators there, any of that type stuff is still in the wheelhouse of most banks. But yeah, small bay, fully leased, all that type stuff. Lower office content, just checking the boxes. I think all that stuff, most banks are still willing to go after.
Okay. Have you seen any signs of distress or positioning opportunities that smart borrowers and lenders should be watching or have taken advantage of? I'd say probably, I hate throwing around this word just because it's not politicized, but it's a very kind of an emotional thing at the moment. Due to tariff, this is changing daily and it makes the economy very volatile. For example, 50% tariffs on steel and aluminum have significantly raised the cost to some manufacturers, and they might decide that it's better for them just to exit the industry. On the flip side of that, that could be an opportunity for somebody in the future to fill that void.
Yeah, certainly. I do think the tariff situation has affected a lot. There's just more uncertainty across the board. And if the banks are feeling that uncertainty, it just leads to longer lead time. They want to do more due diligence on the deal and make sure that they're comfortable with the money that's being lent. Again, it gets back to a lot of money was tied up in these office buildings that are now worth a tenth of the value of what they were appraised at or lent on years ago. Working backwards through a lot of those loans, even though the industrial market is a lot stronger and that is a safer a place for the money to be going, they're still a bit hesitant, I think, because of how underwater some of those loans were and still are in some case. You had to get really creative on the back end to make some of that stuff.
Oh yeah, I mean, there's even I'm doing this right now with an electrical contracting group, but there are office buildings that are sitting at 10% occupancy, and I've started looking at just leasing out parking in their parking garage just to try to recoup some of the costs that they've incurred, and that way it's not draining their bank accounts. As far as green energy incentives, and when it comes to ESG, solar, EV charging, have you seen anything with that coming into play with transactions? Are you able to talk on any type of green energy incentives that you've seen be applied at some of these banks?
Not so much from the banking side. I think if you were to have a conversation with somebody in California, they would have a uniquely different take on this. I do know county government, state level, there's lots of like incentives that are going in certain states to incentivize people to include EV chargers, go more solar powered, things like that. But those are more tax incentives, things on that front. So I'm not as aware of from the banking side what's out there. But I do know that, again, if the building has that and there's tax incentives on it from the government, that's a value add. Like that would get back to telling the story of what you're doing to the bank so that they can factor kind of all sides of it. So I know in talking to my banking friend, they want to know those things. I just don't know if there's specific incentives out there from the banking world at this point. But I would imagine that could change over time. I feel like if from like a national perspective, there's more of a push again toward energy efficiency stuff, which comes and goes. But if that happens, I imagine that the banks will do something to take part in that. I just don't know of anything specific currently.
Yeah, that's fair. Now, winding down here, I guess, where do you see the industrial market heading over the next 12 to 24 months? Obviously there's no crystal ball that make both of our jobs a lot easier if there was, but based off of what you're seeing today, I guess, where do you see this going over the next year or two?
Yeah, I think the industrial market's gonna stay doing well. I think the safest bet is in your smaller local users, 50,000 feet and down. I think the lending on that'll stay busy and still attractive to some extent. Just because that's such a hot market still. The supply and demand is still pretty hot in that space size. So I think it'll stay strong. I think the bigger stuff, we'll just have to see how that goes. A lot of the development is still coming. So that's a lot of space that's entering the market. You might have to see developers approach their finance partners and see about chopping those bigger bulk spaces down into smaller spaces. And why that's important is there's a cost to build out those offices, to shrink the space sizes and increase the tenant amounts. Those are things that the finance partners will have to approve. They underwrote the deal when they find the deal at a certain picture and certain size and certain rental rate. So if you go to change that, you do have to get their permission. So I think those are things that may get looked at if things stay slower on the bigger stuff. I think keep in its own right is strong with the port, with a lot of the infrastructure things we have here. I don't foresee anything but good things happening here over the next 5 to 10 years. But specifically on the finance side, I think any type of user product, anything that's small, I think those will all still be relatively easy to find money for. It'll just be interesting to see what the finance partners want to do if they do start looking at shrinking the space sizes on the bigger bulk stuff.
Just go ahead.
No, I was going to say before we sign off, I had one thing to add about just being proactive on the finance side for user.
Yeah, that's exactly where I was going with it. I was just going to add, how can the lenders and borrowers position themselves to take advantage of where the market is going?
Yeah, absolutely. I take advantage again, just be more proactive on it. And I maybe not take advantage of something, but the best thing that's a borrower can do when they start to go through putting a building under contract and start moving towards trying to get closed, the most important thing they can do be proactive. Know going in the kind of mandatory things that have to happen, appraisals, environmentals, making sure you get started on that day one. Obviously, that's side to inspections and other things that are vastly important to that feasibility period, but not getting started day one and waiting on the bank to push that could lead to not having things ready to go in the allotted time you have. And if you don't have that in place, you're in a bad spot because, Frank, you're asking for more time. And at that point, most sellers are going to ask for more money down to do that. So you're leveraging more out of pocket expense while still waiting for the final approvals from the bank once they have those things in hand. But if you're proactive from the get-go and are able to get those going the first week of being under contract, it just leads to a lot more successful deals. Frankly, I'm going through it right now where a buyer, we pushed to get the bank going and they just didn't. And unfortunately, we're facing a second extension and not sure if it's going to be given. It's a tough place to be. It's not somewhere you want any of your buyers to ever be, or if in this case, we're on the sell side, but it's not a place you want to be because it's hard to get closed. It's hard to continue getting extensions. And it's just because they didn't do what they needed to on the front end.
Yeah, that makes sense. I appreciate you taking some time to talk with me about this today. Is there anything else that you wanted to touch on that we didn't get to today?
No, I think that covers a lot of it. I'm looking forward to doing more of these.
Yeah, excellent. For anybody listening, if there's any questions, comments, concerns that you have for Matt or I, feel free to reach out to us. You can get our contact information through our website. We'll be more than happy to answer any questions that y'all may have.
Thanks, Nathan.
Yeah, have a good day.